Hi, today we are in beautiful Palo Alto in the Venrock office. Hi, who are you and what do you do?
I'm Brian Ascher, a partner here at Venrock.
What is Venrock doing?
So Venrock is an early stage venture capital fund. It's one of the longest standing VC firms in the country and probably the world. Got started actually in the 1930s as the VC arm of the Rockefeller family. And we're in our timeline room where you can see some of the early investments back in the day that Lawrence Rockefeller led. Companies back then, the hot technology space was aerospace and rocketry. So Eastern Airlines and McDonnell Aircraft, Piseki Helicopter, Alaska Airlines, they all got seed funding from Lawrence Rockefeller and his advisors.
Cool. Let's tell us about your story. So you have been quite long here at Venrock. What did you do before?
Yeah, so before becoming a VC, I was product manager at Intuit, responsible for the Quicken product family back in the early days of that product.
And what made you become a venture capitalist?
Yeah, that's a good question. I had some exposure to the industry while at business school and prior to that, and it always seemed like an intriguing thing to do. And so when I was wrapping up my work as a product manager, I decided to apply to the Kauffman Fellowship, which places folks early in their career into venture firms. And I thought, oh, if I get in, cool, I'll see what that's like. And if not, then I'll keep doing startups or something. And I got in and loved it. And I consider it a privilege to work with great entrepreneurs. So
Awesome.
I keep doing it.
Can you briefly walk us through the typical investment due diligence process? So once a startup comes into your office in the beginning of the funnel, and then how is it proceeding?
Yeah, we try to be very flexible and really tailor the approach to the specifics of that company. I like to simplify it into three phases. So the first phase is we'll have a meeting, and I consider it the sniff test. Is there mutual interest after a meeting and maybe a phone call or two or discussing it internally? If yes, then it moves into the second phase, which I like to think of as the high order bit. This is kind of the most important phase because it's where we would drill down on the most important critical few issues. So whatever that could be, it might be understanding the competitive dynamics, better understanding the technology, understanding the market need, what have you, and try and do it quickly, couple of weeks, sometimes faster. And it's really being efficient, but getting through our network or through the company to the heart of the matter. And then the third phase is more of the let's leave no stone unturned. Let's do management reference checks. Let's make sure we've spoken to all the customers. Let's go through the financial model. Let's start to discuss what a deal might look like. Let's examine the cap table. Let's meet the whole partnership, and then we'll decide and move towards a close. But really, it's that second phase, the high order bid or the bang for the buck phase, where you're trying to really zero in on, does this make sense as an investment for Venrock and for you to have us as your partner?
And what is the typical conversion rate from phase 2 to phase 3?
I'd say if it passes phase 2, it's reasonably high. We don't tend to sort of look at numbers very often, but I'd say it's the most important phase, so maybe half.
Okay, cool. And what is the typical time span or range of deals? So maybe like from 4 weeks to 10 months in terms of the whole process?
Well, 10 months would certainly be more of a case where it wasn't right at that time. So we or they agreed, hey, you know, we're gonna revisit this several months down the road, 6 months down the road, and that happens quite a bit. Where for whatever reason the company decides not to raise then, or maybe they raised a small round and they come back to see us with a status update. But rarely would it take us, 6 months of rigorous analysis to get to an answer. That just doesn't happen. So I'd say that we've done deals in as quick as a week. It's not the most comfortable thing to do, and I'd say it's actually not great for either side because it's a very important decision for the entrepreneur to know who they're getting hitched with for the long haul. And it's also really hard to really understand a business that quickly. So I'd say, the comfort zone kind of starts at 2 weeks and maybe goes 4 to 6 weeks. But the difference, at least the way we do it, is once you have a term sheet, we're really, really interested to invest in. It's basically just legal due diligence from there, and that almost never uncovers a problem.
Brian, what is the sweet spot for an investment in terms of sizing or maybe business model industry?
Well, as far as size, we're quite flexible. There's really no lower limit. It's not that we have such a large fund. Unless you could take a lot of money from us, we're not interested. So we could seed something for $500K, but a small check for a proper Series A might be $3 or $4 million. But we've written checks as large as 10 or 11 or 12. That's a big check for us. And then our expectation is that over the life of a company, we may have to double the investment or even triple it sometimes. Really depends on how capital intensive the business is and what we think their future fundraising looks like. As far as sectors, we're very broad in our coverage of both life science, and that's everything from healthcare IT to biotech and diagnostics and medical devices. And then on the IT side, it's everything from infrastructure like security or virtualization to enterprise applications, whether horizontal SaaS like a marketing technology company or vertical solutions in finance or retail or healthcare, on up to consumer plays.
What type of industries or sectors do you find very interesting and promising for the next 2 or 3 years? Seeing that the SaaS market, for example, was very hot over the last 3-4 years, for example.
So I have a theme that is most interesting to me, and it's this notion that software is becoming intelligent. And what I mean by that is you're taking data technologies or approaches rather, like machine learning, predictive analytics, artificial intelligence, although that word is probably overused, and using it to actually answer a business problem or use the computer to provide an actual recommendation to an end user. Because if you think about it, what software has historically been is really a database with a UI on top. That's what Salesforce.com is, or CRM is, or has been, because they're changing, trying to add more intelligence to their app. It's a place that stores customer records, and it's got a UI customized to that task. And to get the value, you have to run a report or look at the records and decide up in your brain what sort of inference you would make, what action you would take, and then how to drive that through the organization. Quicken was really the same thing. It was a place you stored transactions, and we had a checkbook metaphor, and you could run reports and look at a pie chart and figure out where your spending is going and then decide, oh, I should spend less, I should create a budget and do all that. Whereas now, with machine learning and artificial intelligence, you can have the app decide, I'm going to recommend for you ways for you to save money or achieve your financial goals, send your kid to college, retire comfortably. Or in the B2B setting, the software can actually tell you which prospective buyers are out there showing intent in the marketplace that you're not even aware of. And here's how much they're going to buy, what they're going to buy, when they're going to buy it, and here's the message you should deliver as you reach out to them based on the interest that the software is seeing, either on your electronic channels or across the web through various data sources. So I think it's a profound difference in what software will do, not just in terms of how it's deployed or delivered, which was the biggest advantage of taking it from on-premise to the cloud, but really the value. I think it's creating more value for the end user, requiring them to do less work to get the value.
When you look at predictive analytics startups, are you more looking at infrastructure-based companies, or are you looking at SaaS models who are just solving some unique niche problems for some companies, for example? Or are you looking at a company that owns really exclusive data sources, for example?
Yeah, so there's definitely infrastructure opportunities. It's not where I focus my effort. I am focused on the app. And really the key to the app is oftentimes really understanding the domain and the problem and the customer need well enough to know what data you would want and then how to create the answers coming out of that data. It's rarely about cutting edge math. The math isn't easy and it's sophisticated, but no one's inventing new math to come up with the answer. It's really all in problem definition. There's often a lot of data cleansing work that goes on. There is a lot of cleverness you need in sourcing the data. Sometimes it could be unique and proprietary data. A lot of times that's more of a business model and a biz dev kind of advantage. If you can create a network effect, even better, so that you have more data than than the competitors. But really, it's so much about understanding the domain and then presenting it through a user experience that lets the business user or the consumer solve their problem in a quick and delightful way.
What kind of interesting stories did you experience over the last 18 years with entrepreneurs where you say, wow, this was very interesting, this was a problem an entrepreneur occurred and this is how he reacted on it, or where I or some of my partners gave them helpful advice?
Great question. I'd say that the big observation is just how rare the true force of nature entrepreneur is. And by force of nature, we mean that person for whom failure is just not an option, and they will keep coming at the problem and modifying their approach if they need to, and just make a much bigger outcome or company than the innate market suggested was possible. And so when you're in the presence of a truly great entrepreneur who just exudes that sort of drive and energy and creativity and combines this optimism for the future with the pragmatic sense of what it's going to take to get moving today, you don't want to overthink your way out of doing that kinds of investment based on, oh, well, what if this goes wrong, that goes wrong? Because that great entrepreneur will figure it out. Hopefully will help as well. But it is remarkable how there's so much more that's possible than you might envision at the outset. And so it's a great entrepreneur that takes you there.
Many people think that we are currently at the brink of a bubble bursting. What is your perspective on that?
I don't feel like it's a bubble that we had in, let's say, 2000 or even 2008. I think the public markets have remained largely disciplined on valuation. You have some late-stage private valuations that have gotten crazy. But fundamentally, the basis of innovation is incredible right now. There are so many technology catalysts, social catalysts, industries willing to adopt cloud or technology-based solutions, that I feel really good that real innovation, real value is being created. And so if the late stage private markets cool off a little bit, that's okay. That's not going to create some huge explosion and nuclear winter like we had in 2000, 2001, 2, 3. So I think there's a little bit of market cycle on the late stage stuff, but the early stage I think hasn't gotten quite as overheated because there's still so much risk in the beginning, particularly before it's obvious that there's a lot of traction, that I don't spend that much time worrying about timing the market as far as our investments go.
When you look at an entrepreneur coming to you and pitching for an idea, and you are an early stage investor, how do you balance the evaluation of the founder or the founder team with the business idea or business model that is currently the plan?
Yeah, well, it comes back a little bit to if you really hate the idea, then it's hard to meet someone who's so compelling you're going to follow them into an idea you just don't believe in. But if the idea seems a little small, but generally okay, like a good idea, you're just not sure how big, a great entrepreneur is worth backing in that scenario, because you really can never tell just how big an opportunity will be, because there's always opportunities that present themselves once you get into the market and the customers start telling you what else they want, etc. But for us, we're really people-centric, so it's sort of people first and market second. There is a school of thought, the opposite approach is give me a huge market and I'll find the team. It's just really hard to match a great team and pull one together and make sure they're cohesive and was it their initial idea or not. I think there's something special about a founding team that came up with the idea, feels ownership in every fiber of their body, and is going to walk through walls or through fire to make it successful. And so playing with that, or passing by that by bringing in professional management, I think kills some of the magic. So ideally, you're starting with a great team in an interesting market, and then it gets even more exciting as they find their way to the sweet spot.
Brian, imagine you have 10 entrepreneurs in front of you. How do you really identify the great entrepreneur and identify the not so great ones?
It's really hard, and there's always surprises, and I don't think anyone's got it figured out perfectly. But some common traits are that smart is a given. I think there's a lot of smart people in the world, and so it's highly necessary, but insufficient. I think the great entrepreneurs have a personal energy and enthusiasm. And it doesn't necessarily mean they're the life of the party with the lampshade on their head. But you can just tell that their conviction and passion around an idea, and it sort of permeates everything they do and every conversation you have. Then I think they also have this pragmatic sense of, I face a lot of challenges right now, but where I'm going is great. And they're kind of diametrically opposed in a way, because you don't want someone who's just dismissive of all the challenges they have today. Oh, it's great. Oh, we've already got this problem solved. There's nothing else to learn. That's probably not a healthy attitude. Nor is it one who's constantly worried about, we're going to fail and this is wrong, and they're shooting for a nice, safe outcome, not a big outcome. So if you can do both, be abundantly optimistic about the future and really pragmatic and disciplined about the present, that's important. And the best entrepreneurs have this mental agility or flexibility to be constantly taking in feedback and adjusting. And it's not the big, pivot, so to speak, but just all those little adjustments that you need to find your way to the sweet spot of a market and a solution. I guess the last thing I would say is that the best entrepreneurs tend not to get defensive. They can take tough questioning and respond appropriately or with good answers or admission that, hey, that's a risk. I don't know. We're going to figure that one out over time, but that's a risk you as an investor need to be willing to accept along with me. Because I think that however hard the questions coming from an investor might be, the challenges that the market throws at you, competitors throw at you, the key executive that quits, this morning throws at you, those are a much harder problem than a venture capitalist questions. And I think the great entrepreneurs realize that and take them in stride and respond with their best shot at an answer or an answer which says, I don't know yet, I'll figure it out.
Cool. Brian, you've seen so many entrepreneurs. What type of learnings did you see that they made? And based on this, what type of advice could you give them to avoid some unnecessary mistakes?
Yeah, so I think some of the best entrepreneurs are constantly upgrading their team. And that sounds obvious, everyone does that. But the reality is the following. You have a founding team of co-founders and early team members who go through some really, really tough days, long nights and weekends, setbacks, all the time. And so there's a lot of loyalty that develops there. And so as you're growing and maybe things are going great or they're going well, but there's problems, the thought of taking that person who was there from the beginning and bringing someone in on top or even letting them go is actually pretty hard. And if they're doing a pretty good job, you're even less likely to make that change because you feel the sense of loyalty, or I've got bigger problems to solve than the fact that my VP of sales is a B plus and not an A. Mm-hmm. But I think the reality is you constantly have to be striving to have all A players in every single position around your leadership table, because any one weakness can have ripple effects and lead to problems that sneak up on you. They're not glaring problems immediately; those you usually act on. But it's the problem that, oh boy, we felt like we didn't need a CFO until we were planning an IPO, and as a result, we're in all these contracts that have these weird clauses, and our margins are all completely off, and we're drowning in complexity. And these are all the problems that just kind of sneak up on you after a couple of years without really ever screaming, solve me now. And that's one of the problems that good entrepreneurs intuitively know, and many people have to learn the hard way.
What other advice can you share?
I'd say another area that I feel really strongly about is the manner in which an entrepreneur approaches true partnership with their investors or their board. And by true partnership, I mean way beyond just taking their money and then keeping them off your back, which I think is sometimes what an entrepreneur would default to doing, but rather creating this true partnership of trust. And I think there's a virtuous circle that develops if you do that well. And then unfortunately there's a negative circle of mistrust, which can also develop if you don't do it. So the positive trust loop is you as an entrepreneur recognize that my board is here to make me successful. They want this company to succeed. And the same goes for my investors. And they realize that there will be problems. And if I bring problems to them early, they will hopefully help me solve those problems. But even if they don't, they will at least know that I'm aware of them and I'm working hard at finding solutions. And so the next time they have a question in their mind, they'll know that they can ask me or they can have confidence that it's going to be addressed. And this way, there's more and more positive trust going back and forth. The negative loop is really, really insidious, which is I've got a problem as an entrepreneur. I'm worried to tell my board, so I keep it to myself in the hopes that I'll solve the problem and it'll go away before I have to admit it to anybody. The board usually senses, oh, there's something going on here, and you could either see it in their numbers, or even if it doesn't show up in the numbers yet, you just get a sense there's something not quite right, but the CEO is not telling me, so I'm going to have to dig harder to find out what's really going on. And then once I do, I say, aha, I knew it. There was a problem and you didn't tell me, and now I trust you even less. Yeah. So I start to wonder if there are other problems I don't know about. And then you start asking your CEO or digging on your own, and then they get even more paranoid, and the whole thing spirals out of control in a very unproductive way. So I think it's really incumbent on the board and the investors to react constructively when problems are brought to them, because that is what you want. And so I'm of the mindset which does not say, well, don't bring me a problem unless you also have a solution. No, bring me problems early and often. Mm-hmm. That's my job, is to help you solve problems. We can celebrate victories, but we're going to do that this amount of time, and most of the time is going to spend on how do we get even better.
And how do you define the significance level of problems that should be shared and problems that are so minor that should not be shared?
There's really no bright line or rule, dollar amount or anything like that. So I don't mind if they over-communicate. I'd say it's probably the judgment call is around what would be the strategic significance in the short, medium, or long term. Certainly if it's going to be a short-term strategic issue, like a big partner just canceled, absolutely. But you could even take the problems that, hey, it's okay now, but I think it could turn into a problem. Let's talk about it. If it's something like, the lunch was delivered late today, or, employees are leaving the kitchen too messy. Yeah, of course. You don't need to know about that. But generally it's a calibration exercise that, bring the problems early and often, and then you could together figure out what really needs to come, and also what you get value from me from. If you're bringing small problems but I'm helpful, then keep bringing them, as long as you find it value. I'll probably never say, hey, don't bother me with that. That's like beneath me. There's really, in venture capital, it's kind of messy making the sausage, and so I'll help with anything that you want help with. As long as I can be helpful, I'll do it for you.
Cool. Are there any more advice that you can give, especially on the investment side for entrepreneurs?
So my advice on fundraising would really be two things. One is it's become more popular to not use a deck, a presentation when pitching investors. And I think there are certain circumstances, like we may be meeting 6 months ahead of when you plan to fundraise, and it really is just to get to know you. Do we have some chemistry? Can we talk about the business in a free-form way, just exchange of ideas? Maybe we're doing this. That's fine. No need to come with a PowerPoint. That would be weird. But if you're actually in a fundraise mode where you're going to try and drive investment groups to a decision as quickly as possible. I think it's really helpful to have a guided roadmap to the discussion. Keeps you on track, makes sure to get me the information I need in the manner that you want me to have it. And most importantly, there's a lot of data. Like if you want a strong financing and a strong valuation, you're probably going to have some element of traction in there. And even if you haven't launched yet, you're going to want me to know details of the team or the technology. There's almost always numbers. And you just can't talk through a complex graph of numbers. So you have to have some way to communicate with numbers and quantification, and that's going to be with the deck. And you could say, oh, well, I'll send you the deck later. But there's a golden opportunity. We've each carved out 60 minutes from our schedule. Like, put the best foot forward right there in the meeting. And it doesn't mean it has to be a long deck. It doesn't mean you're going to hand me your entire financial model. Just a really well-crafted argument, point by point, the end of which I am pumped. I'm like begging you to take my money. So that's my philosophy on having a great presentation. And the beauty is there's never a wrong time to have a great presentation. Because as an entrepreneur, you're not only pitching investors, but you can have opportunities to talk to the press, to present at conferences, to tell your story to executives you're recruiting. So having a well-crafted storyline and summary deck, always useful. Never a bad time to have that perfected. The second thing would be kind of this notion of a combination of the optimistic and pragmatic, is to come in and not lose credibility by appearing naive. Showing financials that are the best financials anyone's ever achieved in the world, or a market size that is trillions and trillions of dollars, even though your addressable piece is much smaller, but you're promoting the trillions and trillions of spending that goes on in this category, not even for technology, but for everything. Just really showing the balance and demonstrating that you really understand the domain extremely, extremely well. Even if you're not from it, but you're coming in as an outsider to disrupt it, that you've done your homework, you intimately understand customer pain, and you've got a pragmatic sense of all the challenges that it will take to solve this problem, and being open about that. Because that, again, it comes back to the trust loop. The investor could say, oh, this person really knows their stuff. Not, this person's crazy. Like, they have no idea how hard this is going to be. Show me you know how hard it is going to be, but then compel me that you're going to get there anyway. That's an interesting business.
Great. Brian, thank you so much for your time.
Thank you for your interest. This was fun.
Sure, good. And next time you are thinking about pitching to an investor, craft your story very neatly so that Brian or other investors are really happy to invest in your business. Thank you so much. Great.
I hope that was useful.
Sure.